Welcome back to Griffonomics.
Glad to be here.
It is Wednesday, February 4th, 2026. And if you've been staring at your trading terminal this morning, specifically at the semiconductor sector, you might be feeling, well, a mix of confusion and maybe some mild nausea.
It is definitely a messy morning on the markets.
Yeah.
A lot of red where people really expected to see green.
Messy is putting it lightly. We are looking at Advanced Micro Devices, AMD. They just dropped their Q4 earnings report last night. And if you just, glance at the headlines, it looks like a blowout.
A total blowout. Record revenue, beat expectations.
Everything looks up and to the right. And yet the stock, it took a nosedive at the open. It's just flashing red. So the mission for today's deep dive is, I think, pretty clear. We need to explain why the market is throwing a tantrum.
Right.
But more importantly, we need to peel back the layers on what is actually happening underneath the hood here.
Exactly. Because if you just look at the ticker price today, you are reacting to the noise. But if you actually read the transcripts and you look at the technology roadmap
And partnerships.
and understand the partnership details revealed yesterday, you see a massive signal.
Yeah.
We are witnessing a fundamental transformation of this company. And they aren't just selling chips anymore.
Right. The whole narrative is shifting from, Nvidia's little brother to a systems level giant.
The real competitor.
And we have a massive stack of research to get through today. We're talking about a manufacturing flip involving TSMC's 2nm node, which I really want to get into because the physics of that are just fascinating.
Oh, yeah.
And we have a landmark 6-gigawatt deal with OpenAI that has some really strange and, frankly, interesting financial strings attached.
And we have to solve that immediate mystery, right?
Yeah.
Why a $390 million revenue surprise from China actually scared investors instead of, making them happy.
Right. It really is a paradox. Record-breaking quarter, stock goes down. So for everyone listening who is wondering if this is a buy-the-dip moment or maybe a run-for-the-hills moment, stay tuned.
Let's get into it.
Let's start with the crime scene, though, the Q4 numbers. What actually happened yesterday?
So if you look at the top line, the numbers were, undeniably strong. AMD hit record revenue of $10.3 billion for the fourth quarter.
That's up 34% year over year.
Right.
34% growth for a hardware company of this size is usually cause for a parade, not a sell-off.
Absolutely. And the mix of that revenue is what's so critical here. The data center segment, that's the AI chips, the MI350s, the server CPUs, is now the beast.
The main engine.
It made up over 50% of that total revenue, coming in at, $5.38 billion. Even the PC side, the client revenue, hit a record $3.1 billion. So on the surface, all the engines are firing.
Okay, so the engines are firing, the car's moving fast, they made more money than ever. Why did Wall Street slash the tires? Why the big sell-off?
It comes down to a concept that analysts call the quality of the beat. The quality.
Investors felt this was a low-quality beat.
A low-quality beat. Cash is cash, isn't it?
Yeah.
Or are we just being snobs about where the money comes from?
Well, Wall Street is the ultimate snob when it comes to predictability. So here's the issue. Inside that shiny gift box of record revenue, there was a surprise.
Okay.
AMD revealed that $390 million of that revenue came from sales of the MI308 chip to China.
Okay, so they managed to sell chips to China despite all the export controls.
Yeah.
Why is that bad news?
Because it wasn't in the previous guidance. It was a
Okay.
one-time windfall. It's like finding a bonus check in the mail.
Great for today?
It's great for today, but you can't build a budget on it for next month. And sure enough, when they gave guidance for Q1 2026, the quarter we are in right now, they projected those China sales would drop to just $100 million.
Ah, I see. So the investors looked at that huge Q4 number, realized nearly $400 million of it was this volatile one-time burst from China, and then figured the organic growth without that windfall looks slightly less explosive. Precisely. It's all about sustainability.
Yep.
Wall Street hates volatility. And the China export situation is, it's the definition of volatile. The government could change the rules tomorrow, and that number just goes to zero.
So investors are basically just stripping that money out of their models.
They are.
Yeah.
If you remove that $390 million, the growth curve looks a little flatter in the immediate short term.
And I saw some grumbling about margins, too. The reported gross margin was 57%. That seems pretty healthy, no?
It is healthy, but again, it came with an asterisk. That 57% number included a $360 million reserve release.
Okay, reserve release. That sounds like some serious accountant speak. Can you translate that for us?
Sure. Think of a reserve release like finding a $20 bill in your winter coat that you forgot about.
Okay.
You have $20 more today, which is great, but you didn't actually earn it today, and you certainly can't count on finding another $20 in the other pocket next quarter.
Ah.
Essentially, it was inventory provisions or accounting adjustments they previously set aside and then realized, oh, we don't need this.
So they just moved money from one bucket to another on the spreadsheet.
Exactly. And if you normalize it, if you strip out that accounting magic, the real run rate margin is closer to 55%. So you have investors questioning the true profitability baseline.
So they're asking, are you actually making 57% on every chip, or are you just tidying up the books?
That's the question.
Okay, so that explains the noise. That explains why the algo traders sold the news. But let's pivot. Because while the accountants are worrying about a few percentage points on margin, the engineers seem to be popping champagne about something called the manufacturing flip.
This is the part that gets me excited. This is the strategic inflection point that I think the market is completely missing today.
Okay.
For the last few years, Nvidia's generally had the best chips on the best manufacturing nodes. It's just been a fact.
Right.
But in 2026, the script is flipping.
How so? Because usually everyone just waits in line at TSMC and gets the same stuff, more or less.
Usually, yes. But timing is everything. AMD confirmed that their upcoming Venice CPUs, that's the Zen 6 architecture, and their MI458i accelerators are going to be built on TSMC's 2nm node, the N2 process.
2 nanometers. And just for context, where is NVIDIA expected to be with their next generation?
The expectation is that NVIDIA's upcoming Rubin architecture will rely on the 3nm process.
Wait, hold on. Why would NVIDIA, the king of the hill, stay on 3 nanometers, 2 nanometers available? Did they just miss the boat, or is there a catch?
There is always a catch in semi-manufacturing. Always. Moving to a brand new node, especially one as advanced as 2 nanometers, is incredibly risky.
Okay.
The yields, the number of working chips you get per wafer, they might be low at first. It's expensive. It's difficult. NVIDIA, being the incumbent with this massive lead, might be just choosing safety.
They're playing it safe.
They know 3nm works. They can pump out millions of chips with high reliability.
So NVIDIA chooses safety and AMD chooses aggression.
AMD chooses to take the risk to get the performance crown. By jumping to 2 millimeters, they're targeting a transistor density that NVIDIA literally, physically cannot match in that generation.
We're talking about the laws of physics here.
We are. 2 nanometers allows for a shorter distance for electrons to travel.
Which means what for the actual customer running a data center?
It means a potential 10 to 15% performance edge, or, and this might be even more important, a 25 to 30% reduction in power consumption.
And we know power is everything right now.
It's the new currency. Data centers are completely power constrained. We're reaching the limits of the power grid in places like Northern Virginia and Silicon Valley.
Right.
So if you're a hyperscaler, a Microsoft or a Meta, and you can get the same performance for 30% less electricity, that saves you millions, maybe hundreds of millions, in OpEx.
And it's not just the electric bill, is it? It's also about density.
Exactly.
Yeah.
Less heat means you can pack more chips into the same server rack before the air conditioning just gives up. This manufacturing lead is the spear tip for AMD's goal to capture over 50% of the server CPU market.
Wait, 50%? Historically, they were this scrappy underdog fighting for like 20%.
We've been climbing from the high 20s.
Yeah.
But getting to over 50%, that would mean they are effectively the market standard. They'd be displacing Intel as the dominant player.
Wow.
And that 2 nanometer advantage is how they plan to do it.
Yeah.
They are betting that efficiency wins the war.
That is a bold, bold bet. But having the best chip is one thing. Having someone to actually buy it is another.
Mm-hmm.
And that brings us to the biggest headline of the earnings call, the partnership with OpenAI.
It's a validator.
Right. We've heard rumors for months, but this is official now. A definitive agreement, 6 gigawatts of compute.
I don't think people really realize how big 6 gigawatts is.
Yeah, put that in perspective for us.
6 gigawatts is roughly the power consumption of a massive metropolitan area. It's the output of several nuclear power plants.
Wow.
This isn't just buying a few servers for a back room. This is an infrastructure rollout ramping from late 2026 all the way through 2030. It is a commitment to build the backbone of the next generation of AI on AMD hardware.
But there is a detail in the contract that really caught my eye. It's not just, here is cash, give me chips. There are warrants involved.
This is the financial alignment piece, and honestly, it's the most fascinating part of the entire deal.
All right.
The agreement includes performance-based warrants. Essentially, OpenAI gets the right to buy AMD equity at a certain price if, and this is the key, only if they help ramp the revenue.
Okay, let me play devil's advocate for a second. OpenAI is flush with cash. They have billions in funding. Do they really care about making a little profit on some AMD stock options? Is that really enough to move the needle for them?
It's not about the profit, it's about the leverage in the culture.
Okay.
Think about the game theory here. If OpenAI relies solely on Nvidia, Nvidia has infinite pricing power.
Right, they're the only game in town.
Exactly, they can charge whatever they want. By taking warrants in AMD, OpenAI is essentially hedging their own hardware costs. If they make AMD successful, the stock goes up, which then offsets the cost of the very chips they are buying. It's a brilliant financial hedge against a monopoly.
That makes perfect sense on a CFO level. But what about the engineers on the ground?
That's the cultural piece. One of the biggest hurdles for AMD has always been software optimization. Nvidia's CUDA software is the gold standard.
It's the moat.
It's the moat. By giving OpenAI a financial stake in AMD's success, you are effectively recruiting OpenAI's own engineers to optimize their models for AMD's hardware.
So it just removes all the friction.
Totally. Previously, if an engineer spent a week optimizing code for an AMD chip, their boss might ask, why aren't you working on the Nvidia cluster that's our main production environment?
Right.
Now, that optimization work is arguably an investment in the company's own assets. It completely changes the internal ROI of fixing AMD software.
That is incredibly shrewd. You're turning your biggest customer into your R&D partner. But does this mean OpenAI is dumping Nvidia? I guess I can't imagine they can just flip a switch overnight.
No, and we need to be very clear on that. They aren't replacing Nvidia. They are diversifying. They need so much compute that they literally cannot rely on a single vendor. They need a second ecosystem to avoid bottlenecks.
So it's about supply chain security as much as it is about cost.
And scale. The 6GW deal proves AMD has graduated. They are not in the testing phase anymore. They are in production scale.
Speaking of scale, let's talk about the hardware itself, because looking at the roadmap, AMD isn't just selling the chip anymore. They are selling the whole rack, this Helios platform.
This is the shift from component vendor to systems builder. And this is where they are really, truly taking the fight to Nvidia. The Helios platform is what they call a Yada-scale rack.
Yada scale. It sounds like a weapon from a sci-fi movie. What does that actually mean?
And it means density that is just hard to comprehend. A single Helios rack contains over 18,000 CDNA5 compute units.
Wow.
Now, to be clear for you listening, that refers to the compute cores within the GPUs, not 18,000 physical cards. That would be a skyscraper. But it also packs 4,600 Zen 6 CPU cores.
That is a staggering amount of compute in one single cabinet.
It is. And the secret sauce isn't just the chips, it's how they talk to each other. They were using the Ultra Accelerator Link, or UAL, and standard Ethernet networking.
Why does the networking matter? I feel like cables are kind of the boring part.
The cables are actually the battlefield. NVIDIA uses proprietary networking like NVLink and InfiniBand.
Right.
If you buy NVIDIA GPUs, you really need to use their networking gear to get the best performance. It's like Apple's walled garden. It works great, but you can't leave.
And AMD is positioning itself as the Android in this analogy.
In a way, yes. AMD is pushing open standards. They're telling the hyperscalers, look, you can use our racks and you can plug them into your existing Ethernet networks. We won't lock you in.
That's a very appealing pitch.
It's a hugely appealing pitch to companies like Meta and Microsoft who are terrified of vendor lock-in.
It's the open ecosystem play. And sitting at the heart of this rack is the new chip, the MI455. I saw the specs on this. 320 billion transistors.
320 billion. I mean, just think about that number for a second.
How do you even make that? That sounds way too big to print.
You don't put it all at once. That's the trick. It uses advanced packaging and 3D stacking. They're literally stacking the memory, the new HBM4 memory, directly on top of the compute to speed things up.
I see.
And this allows AMD to compete for the entire capital expenditure dollar. Before, they just got paid for the silicon slice. Now with Helios, they get paid for the networking, the metal, the cooling, the whole system.
Which connects back to the margin discussion we had earlier. Selling the metal and the fans probably has lower margins than the silicon itself, right?
Correct. And that's one of the risks we have to watch. Selling full racks dilutes your percentage margin, even if it adds total profit dollars. It's a trade-off. You get more revenue, but your gross margin percentage might dip, which, it scares investors who only look at spreadsheets.
Let's touch on software again. You mentioned OpenAI is now incentivized to fix it, but where is it right now? Because the knock on AMD has always been great hardware, terrible software.
That gap is closing so rapidly. Their software stack, ROCm, has made massive strides. It now runs 100% of Hugging Face models out of the box.
100%. That's a bold claim.
It is, but it's verified. And that's a huge milestone. And you have Meta co-developing on the PyTorch stack. PyTorch is becoming the industry standard, and it's hardware agnostic.
Right.
The more the industry moves to PyTorch, the less NVIDIA's CAD mode even matters.
It seems like the entire industry is slowly ganging up to build a bridge over the CDA mode.
That is exactly what is happening.
Yeah.
And it's not just for LLMs and chatbots. I was reading through the notes about the embedded segment pivoting to physical AI.
Yeah, I saw that term, physical AI. Is that just marketing speak for robotics?
It's robotics, but it's also high-end simulation. This is the sleeper hit of the report. Everyone looks at the data center, but AMD's embedded business, mostly the old Golinks acquisition, is pivoting to aerospace and physical machines.
Give us some examples. What does this look like in the wild?
Well, just look at the supercomputers. El Capitan is the world's fastest supercomputer powered by AMD. It's not writing poetry. It's modeling virus mutations and pandemic responses.
Okay.
Then you have Lumi in Finland running these incredibly complex climate models.
And I saw a mention of a company called World Labs.
Yes, founded by Fei-Fei Li, who is basically the godmother of AI. They were using AMD chips for 3D generative models, literally building 3D worlds. And a company called Abshai is using them for engineering biology.
So this proves they're winning in other areas.
It shows that AMD is winning in high-precision scientific computing, which is a very different beast than just training a chatbot to summarize your emails.
Okay, so we have the tech, we have the partners, we have the manufacturing lead, but we still have that stock drop. We have to talk about the risks. Why are some people still betting against this? Is it just the China thing?
China is part of it, for sure, but the bigger fear is execution and cash burn. We talked about the margins, but look at the operating expenses. OpEx is rising to $3.05 billion in Q1 2026 alone.
$3 billion in a single quarter. That is a lot of cash to burn.
It is. They are pouring money into R&D to keep up with Nvidia. And Wall Street gets very nervous when spending goes up before the revenue fully ramps.
Okay.
They need that revenue growth to outpace this spending by the second half of 2026.
It's a race against time, basically.
Exactly. If the OpenAI ramp hits a snag, or if those 2-nanometer yields we talked about aren't good, that cash burn becomes a massive problem. They are spending money like they are already the co-leader. They have to prove they can earn it.
And then there's the China factor we started with. Is that risk gone now that they lowered the guidance so much?
In a way, yes. By guiding for only $100 million in China sales for Q1, they've effectively de-risked the forecast.
Okay.
Investors are now discounting China revenue to near zero. So any sales they do make there are just upside. But the volatility spooked people. It reminded everyone that geopolitics can wreck a quarterly report in a heartbeat.
So let's bring it to a verdict. We have the China paradox causing a sell-off, weighing against this massive potential from the OpenAI deal and the 2-nanometer lead. What is the smart money doing?
The consensus from the analysts who dig deep, the ones not just reading headlines, is buy the dip.
Why? Convince me.
Because they view the current drop as a reaction to short-term noise, the China fluctuation and the accounting cleanup, while ignoring the massive long-term signal. The quantitative analysis puts the fair value target around $405 per share.
And it's trading around, what, $200 right now?
Roughly. So you're looking at a potential double if the thesis holds.
Yeah.
The argument is that AMD has successfully transformed. They are no longer the cheap alternative.
Right.
With 2-nanometer, they are the performance alternative. With Helios, they are the infrastructure alternative.
Risk defined, portfolio protected, as the saying goes. So let's wrap this up. We started with a confusing market reaction, but what we found is a company at a massive pivot point.
Absolutely. They have the manufacturing lead for 2026. They have the biggest partner in AI with OpenAI.
Yeah.
And they have a new rack-scale architecture that appeals to everyone who wants open standards.
And for you listening, the lesson here isn't just about AMD stock. It's a lesson in how technology shifts. The underdog didn't just try to run faster on the same track. They changed the game. They moved from chip speed to system efficiency and open standards. They found a wedge power efficiency and vendor freedom, and they just drove it hard.
And they aligned their financial incentives with their biggest customers. That warrants deal is the master stroke that changes the incentives of the whole industry.
I want to leave you with one final thought to chew on. We talked about those warrants. OpenAI has a financial stake in AMD's success. AMD likely has the superior manufacturing node for 2026. If the biggest AI consumer in the world is actively incentivized to make a competitor successful, are we witnessing the end of the single vendor monopoly in AI? And what happens to the pace of innovation and the cost of intelligence when there are two giants fighting for the crown instead of just one?
That is the trillion-dollar question. Competition usually drives prices down and innovation up.
Yeah.
If that happens here, the real winner isn't AMD or Nvidia. It's everyone using AI.
We will be watching closely. Thanks for diving deep with us today on Griffonomics.
Thanks for having me.
We'll see you next time.